Hello. Today we're going to look at a portfolio that is market proof, risk managed, and it only has two positions, two stocks. This is something that would be appropriate for the crazy market we have now. You look at the headlines, coronavirus live updates. That's not good. Goldman says the underestimating the coronavirus correction is looking much more possible. I mean, there's no good news out there, and yet the market keeps going up. So we're going to discuss about what type of portfolio would be appropriate and how to use it. So, as I said, this portfolio would have two positions. The first position would be VTI, which is the total stock market. So the diversification would be there, and if whatever the market's going to do, this will go along with it, which is to be expected. The second position we're going to look at is the VIX. Now this is considered the fear gauge. It is very volatile when the market goes down, and the VIX is now at almost a generation low. I mean, the generation low is $13.15. It's now at 13.56. So it's very close to an all-time low, whereas the VTI is at an all-time high. So this is a pretty good setup for risk management. So the very lowest, in looking back 52 weeks with the VXX, it was at 13.15, but at the end of 2018, when we had that correction, it went all the way to $34.59. So that's a good hedge. It gives you some good downside protection. So the first thing we're going to look at is how to do that. What you do is, if you had $1,000 to invest, you would put 85% of it in the VTI, and then you would put the other 15% in VXX. Then once you had your VTI position, you would put a conditional order in, which means a conditional order is, you say, you hit the sell button and it says you want to do a trailing stop. Now what a trailing stop is, it'll let your position, the VTI, go up as much as it wants, but it just won't let it come down. So if you put a sell condition like a 5% trailing stop, when it comes down 5%, it will execute the trade and sell you out of the market. So this is one of the ways you define your risk, and it's very simple. If it comes down 5%, you're gone. And then the second part of the portfolio is the VXX. Now what would happen here, as the market declines, the VTI position stops out at negative 5%. The portfolio at this time only has the VXX position, which will continue increasing as the market falls. So right now you're net short. You don't have any long position, and the VXX will go up as long as the market goes down. So as we saw before, in the end of 2018, it went from 13 to 35 or 34. So this is what you do to mitigate risk in crazy markets like this with the coronavirus, and everybody says we're going to have a correction. Pretty soon it's going to be a self-fulfilling prophecy. But anyway, then when your VXX is going up, you put a trailing stop on that, because what happens when the market decides it's done correcting, it usually has like a V recovery. It starts up pretty quickly, and the VXX, as quickly as it goes up, it goes down. So you put a trailing stop of either 5% or 10% on the VIX, and when the market starts to recover, you're out of the VIX position and you're essentially flat, meaning you don't have a position. So then when the market starts to recover, you reacquire your VTI position and write it up for the market recovery. Now this is very successful in times like this, because you limit your downside risk, you have an upside when the market is going down, it's a good setup. Okay, this is how this looks with $1,000 investment. You take the VTI position, you take 85% of the $1,000 or $850. The VTI is trading at $172, so you can buy 5 shares. And then you put a conditional order, which means it's a trailing stop and not a trailing stop limit. You want a trailing stop. You want it to execute a market sell when it hits the 5% down. So let's assume the market tanks, it declines to 5%, and it hits the $817 trigger price. So that means you are now out of the market. You have $817, you've lost $34 as you stopped out of the market. Now let's look at the right side. With the other $150, you bought VXX at $12.50 a share, so you ended up with 12 shares. So the market tanks 5%. You're out on the long side, the VTI is gone. Usually when you get a decline like that, the VXX goes up 10%. And so the VXX, your short position went up $15. So your net loss so far is $19. So let's assume that the market continues to go down, because generally after it goes through 5%, there's something going on in the market, and it's pretty likely it's going to go down more than just 5%. So let's say it goes into a full bear market, which is down 20%, just like it did in 2018 at the end of it. I mean, it took out the whole year's gains in 1 month. So the VXX now goes to $34.50, which was the 52 recent high, which was in that time period. So now you've got 12 shares at $34.50 a share, and that's $414. Now remember this. I mean, your entire investment was only $1,000. So this VXX strategy, I mean, really comes into play if the market decides it's really going to get crazy. But let's suppose it doesn't, and it just keeps going on. So for today, to February 19th, the VTI was up $5.55. The VXX was down some. It was down $2.76 total. So you still made $2.79. So if nothing happens, you're still going to make some money. It's not going to be as much, and it's called a risk budget. But if the market blows up, you will actually do quite a bit better. So here's hoping the market blows up, but not really. But this is a way you can protect yourself, you can make some money, whether the market's going up or whether the market's going down. And then, like, once again, when you hit the $414, or you on the way up, you put a 5% trailing stop on the 150 shares. So, or 5 or 10%. Then what that means is then this VIX position will go up and down quickly. So when the market turns, generally, you get capitulation, and then all of a sudden the market's up like 400 points. This will stop you out of that position and save your profit. And then you wait a couple days and you take all that money over, and then you buy more VTI and ride it on the way back up. But at this point, you really wouldn't buy the VXX, because as the VTI in the market goes up, the VIX will go down quickly, and it'll get down to $12.50 a share quite quickly. So you just want to take your money and run on that position. And then when the market looks like it's getting toppy, it looks like there's something, coronavirus or something in the wind, that's when you put your hedge in, and that would be your VIX position at a 15%, and rinse and repeat. And this, we'll see going forward if this actually works. I know it will, but we'll just, to what degree, we will soon find out.